Does all this GameStop and Robinhood craziness this past week set a precedent of what could happen with the housing industry? Can we draw some parallels? I think we can. We'll talk about it in a second. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Randy Patrick here, putting the realism back in real estate on this first day of February 2021. January is a pretty crazy time. I mean, it was a busy month, a lot going on. Hopefully February will be a little quieter, but who knows? We've got GameStop, Robinhood issues. We've got silver going nuts these days. So lots happening. Let's talk about housing. But first of all, if you're not already subscribing to my channel, if you'd help my channel grow and smash that subscribe button, I would really appreciate it. So thank you very much. So what are we talking about today? Well, really, the news of the week has been GameStop being shorted by Robinhood appetite, small trader investors, causing chaos in the the stock market industry. And you know what? Lots of videos, a lot of people are talking about this. So clearly, I look at something like this as what? Well, this is kind of your typical, what would you call it? Maybe clickbait. All right. Lots of videos out there that are going to show this or talk about this to drive you. And I'm doing the same thing. What the heck, right? So, yeah, but the point, though, here is that it's not the fact that this is happening. It's the end result that concerns me, and how, the powers that be are controlling the outcome of this. And actually, once again, the little guy gets hurt. So the funny thing is, and you see this going on right now on the internet, what was Robinhood known for? Well, if you know anything about Robinhood, or have watched the movies or read the books or stories, Robinhood was known for robbing from the rich and giving back to the poor. That was Robinhood's stance. And this is actually a photo from the original Robin Hood movie in 1938 starring Earl Flynn. So there you go. Pretty cool. So today it's more like rob from the poor and give to the rich, and changing the rules of the game on the fly to benefit Wall Street if things don't look too good. All right, and that's kind of what's happening right now. So when I'm saying, could this be paralleling the housing industry? You betcha. It's actually happening right now. It's been going on for quite some time, and we need to actually be aware of it. So as I say, it seems like the same thing is occurring within the housing market. It's happening right under our very eyes. It actually occurred a number of years ago. That's when it started, and it's still going on, but it will happen again in a larger, we'll call it scenario, as time rolls on this year, next year. What do I mean by this? Well, wealth transfer has begun. It actually began a number of years ago, back when we had the last housing boom, bust, crash, and crisis. We had lots of foreclosures, and what eventually happened to those foreclosures? Well, guess what? Big Wall Street hedge funds, investors came in and bought all those foreclosures at the foreclosure auction. Lenders didn't put them back out into the marketplace. They sold them as non-performing loans or assets to other hedge funds, etc. They controlled and manipulated the market, thus giving us the housing recovery that we're in right now. Also, statistics aren't adding up. When I talk about that, I'm going to go over some of the foreclosure and forbearance statistics that are displayed and shown to us on a monthly, weekly basis. And quite frankly, the numbers aren't adding up, which means there's a lot of holes in the reporting, or there's a lot of, we'll call it latitude with respect to estimates, etc. In the end, why is this a concern to me? Because I don't like people telling me what to do. It's the little guy, the mon pa landlords, mon pa investors, people like us who just want to buy a house to live in at a decent price. We're the ones getting hurt. And right now, the issue is that we're seeing no relief coming into the marketplace that makes any material difference with respect to housing whatsoever. So that's why we're getting set up for another fall here. So now, according to Redfin, okay, guess what? Housing supply is at another all-time low. So the number of homes for sale dropped significantly across the country in January, according to Redfin. Data from real estate analytics firm revealed that the total number of homes for sale fell to an all-time low of 34% year over year in the 4 weeks ending January 17th, with new listings down 10%, which Redfin said was the biggest drop in 7 months. And what we're also seeing as a byproduct of this is housing supply in rural areas plummeted a record 44% for the first 4 weeks ending January 21st, compared to the same period last year, while the number of homes in suburban areas fell 38.4%. So what we are seeing is the fact that people leaving urban areas, going to the rural slash suburban or exurbs because of whatever reason, COVID, isolation, relocation, better cost of living, et cetera, et cetera. So we're seeing that kind of play out in the marketplace right now. So no surprise here. This is what they've said, and of course we see it from Realtor.com and NAR, et cetera. Now, something interesting here. We've got, I guess you could say pending home sales dropped for the fourth straight month. And as a byproduct of lack of inventory, now we're seeing pending homes. So pending homes are homes that go under contract. These are homes that are on the MLS, multiple listing service across the country. There's a pending home index that National Association of Realtors puts out there. So pending homes mean it's gone under contract, but hasn't yet gone to sale. That's a future closed sale in 30, 45, 60 days, whatever that is. And just as another side note here, believe it or not, because of all the refi that's going on, refi of mortgages, I read the other day that it's taking on average 58 days to close a loan. So new buyers that are coming into the marketplace, or repeat buyers, whatever, if you're buying an existing home, it's going to take you a while to get that home closed just because of the volume of refis are going on. And how does that impact the marketplace? Well, refis basically need appraisals, and appraisers are out 2 or 3 weeks on their booking. So just everything holds, everything just is delayed. You need a home inspection, whatever. So all these subsidiary type industries that support a real estate closing are getting, they're busy, which is great, but it's slowing things down because of the volume of what's going on right now. And so even though the volume's up, in the end, we're seeing pending sales down because of inventory levels. So just, that it all ties together, which is, we can see where this is headed. Now, what also has come up here is the fact that, guess what? New home sales disappoint as prices sort of record high. So what we're seeing here is the fact that new home sales rebounded very modestly in December after tumbling in November, but printed significantly below expectations. So purchases of new single-family houses increased 1.6% month over month, the first gain in 5 months. So they look like they wanted more, but they were expected to come in at 870,000 seasonally adjusted annual rate, but only managed to rebound from a downwardly revised 829 to 842 seasonally adjusted rate. Now, the main issue though here, so obviously we saw a little bit of a hit there on the new housing, but the main issue is that it does not take rocket science to comprehend the driver of the recent slowdown in sales. Record median home prices rose 8% year over year to $355,900. Now, this number has sort of bounced up and down a little bit here, but I think the last, I recall seeing it in like the 330s, then in the 320s, close to low 320s. If it bumped up to 355, I can tell it's going to push, it's going to be out of the range. It just pushes it out of range for more people, or people are going to go, wait a second, maybe I need to reflect at what I'm doing here and see what's going on. And we know that, the median price of a new home is more expensive than the median price of an existing home. Now, and albeit it doesn't make sense, but the new home, what do you get? You get new materials. You get a 30-year, 25 or 30-year roof life. You get typically a 10 to 15-year builder warranty. Any appliances that are in there are good for a year or 2 years. Your AC units are good for at least 10 years. So, obviously, when you buy a new home, you get the benefit of lack of deferred maintenance for a long period of time. So I get that. But once again, we see price points are rising in that segment, which is going to, hurt prospective home buyers for sure. This just came out from MPA Mag, basically revealed how many renters owe their landlords back rent. Newly released survey from rental search platform ApartmentList.com shows a shocking 28% of renters started off 2021 with unpaid rent bills from previous months. This rent debt, according to the survey, is especially concentrated among younger renters and people of color. While rent debt improved marginally from October 2020, recent downturns in unemployment might point to a worsening situation for renters and a lack of cash flow for landlords. So this is troubling. Now, again, this statistically, we see that this, other people who are reporting this, other groups, other internet sites may show a difference. So this is where I always have difficulties. Is it 28%? Is it 17%? Is it 22%? So we're going to see, is it just apartments? Do they, this is from Apartment List. Is it, what about single family homes? People who rent that. So this is there's difficulty in getting statistics, but in the end, I think the net result is more renters are having more distress and are having more and more unpaid rent bills as the months go on, which will do what? Affect landlords and cause future problems for landlords. Now, when we talk about future problems for landlords, which tends to be a segment that nobody cares about, and the reason why I care about it is because, the mon-pa landlords are actually the number one provider of rental accommodation across the country. You see, and if you take a look at the charts, I'll make this larger in a sec, but this is a huge housing risk. Millions of private single-family landlords worth trillions are a serious liquidation risk. First loss is best loss. So when we go look at this a little deeper, if we take a look at that, there's roughly 20 million single-family rental home markets. It's much larger than multifamily. You can say 85% of the single-family rental stock is controlled by the mon-pa investors, which are largely shut out of the liquid mortgage market because they are private investors. There's no government loan deferment for most landlords with mortgages, and new mortgage liquidity is hard. Default strategy of selling to tenants is not feasible. So listen, if you think about this, when did some of these, rental and foreclosure and eviction, I guess you could say moratoriums come into play? They came into play end of March, early April. So we're into 10 months now. So in theory, you could be a landlord and you could have not been paid by your tenant for 10 months now? That's pretty tough. I mean, how many landlords have 10 months worth of, we'll call it reserves to pay off their mortgage when they still have to pay for insurance? They still have to pay possibly for some utilities. They still have to pay for property tax. So there's all these things that are impacting a mon-pa single-family landlord that have to be paid, and even though the renter is not paying, right? So renters are protected from eviction, and I'm just saying it's tough. So it's tough for this segment. This is what's going to happen. This segment will start to crumble, and this segment is not really discussed or I even think factored into what's going to happen in the future, because we just look at single-family owner occupants primarily. This is this wild card number that could really make a difference in the industry. So take a look at the overall rent market. This is a bit fuzzy because I had to blow this up, but if you take a look at the estimated market share, when you look at portfolio size, right? Portfolio size is 1 to 10. 1 to 10 units. So essentially, 88% of the overall rental market's controlled by very small renters that have 1 to 10 units in their portfolio. So, these people don't have, they're not backed by hedge funds. They're not backed by institutional investors. So this is where the difficulty can arise. And this is where I can tell you that the next tier, the middle tier and the institutional investors are licking their chops, waiting for this market to crumble so they can step in and take that over for them. Simple as that, guys. So that's why it's not talked about. And we talk about owner occupants. That's typically where the statistics go. A typical, mon-pa landlord with a mortgage, chances are will not be able to fall into a forbearance program. But in the end, they got to pay the money back as well too. So you see, this is a number where please understand, this is the wild card that no one talks about that could really decimate the housing industry and also create opportunities for the future. But this is why I harp on this, because as I said, I'm pro affordable housing. You have to have a mix of affordable housing, affordable rentals, landlords, builders, the whole bit. It all has to work in unison, in harmony. But we're going to have major problems in this segment for sure. So let's go to some delinquencies. So guess what? FHA, this is put out by the American Enterprise Institute. They put out, they go to the FHA and they get the information on the FHA delinquencies. So basically what we're looking at here, so December 2020, we saw what? We saw a 0.1% reduction in overall FHA delinquency. So the overall delinquency went from 17.5% of all FHA mortgages in November to 17.4% of all FHA mortgages in December. So we saw a very, very small decrease in delinquencies. For what reason, don't know. However, seriously delinquent remained the same and plateaued, or 11.8%. Seriously delinquent, for our purposes, are typically 90 days plus of not paying your mortgage. All right, simple as that. FHA has a higher hit rate here. Now, so they also produce the information. If you want the website, not the website, if you want the spreadsheet, I can just email me. I'll email you the spreadsheet. But here's the deal here is that the 10 most threatened metros based on FHA delinquency rates through 12/31, so the end of the year, still doesn't change. It still shows that Atlanta's the number one location, Houston area is next, Chicago area after that, Washington area, Dallas, Plano, Irving, Riverside, San Bernardino, Baltimore area, San Antonio area, Orlando, Kissimmee area, and Tampa, St. Petersburg area. So that's your sort of, we'll say it, with respect to active counts, total delinquent loans. You've got some pretty, big numbers in these locations. As a percentage point, the total delinquent loans are as a percentage of the delinquent loans, the delinquent loans as a percentage of the total active portfolio in those locations. So we see that, we got in the 20s, 22, 20, 21, high teens, and this is the most threatened. We take a look at the seriously delinquent loans of that segment, which are 90 days plus, and the FHA share of metro lending in 2019 counts. Why this is important is the fact that I believe this column, what it means is the fact that out of all the FHA loans that were originated in 2019 in this metro, this is the percentage of delinquencies out of that loan vintage. So, for example, in Atlanta, 21% of the FHA loans that were originated in the year 2019 are 21% of them are already delinquent in 2020 or at the end of this year. So that doesn't bode well. And that really, to me, that speaks volumes of, was it credit issues? Was it job issues? Was it debt to income ratio issue? So when there's changes in someone's personal economy, what does it cause delinquency? So when you delve deeper into this, you can see that there are problems. And this is now the FHA is the largest segment of delinquencies, but I would hesitate to guess that in these regions, if we go to what's the delinquency count for conventional loans or GSE type loans, they're not going to be this high, but we'll probably see that they're going to, the top 10 are probably going to have a lot of, other delinquencies as well too. So this shouldn't come as any surprise to anyone. All right. So let's go to the next slide here. And what do we got? What do we got here? I'm just waiting for it to go over. Sometimes things are slow with this software. So Black Knight talks about national mortgage delinquency rates in December here. I know it's tough to read, but I'll show you a graph here. So this is where I get into some of the statistical anomalies. So it really is, how can I put it? This is where I just think a lot of it, I know a lot of it's based on estimates, so we're not going to get real numbers here, and I accept that, but they do fluctuate. The year ended with 1.54 million more delinquent and 1.7 million more seriously delinquent mortgages than at the start of 2020, a looming reminder of the challenges facing the market in 2021. Despite the year-over-year increase, the national delinquency rate saw modest improvement in December, falling by 3.9% from November, the lowest level since April 2020. Serious delinquencies, loans 90 or more days past due, also improved, falling to 2.15 million from 2.19 million in the prior month. Even after months of improvement, 90-day default activity rose by more than 250%. It's plus 2.6 million overall in 2020. Obviously, foreclosure starts fell by 67%. Why? Because the foreclosure starts just aren't happening due to some of the moratorium. So foreclosures aren't being processed like they used to, nor are the starts going on like they used to. Now, prepayment has gone up. And why? Well, we learned that prepayment, it's because if you're refining, you're prepaying your loan. Simple as that. So that's gone up due to the number of refis. Now, here is what Black Knight put out. So percent loans delinquent and in foreclosure process. So when we look at, you've got December 2020 column, November 2020 column, December 2019, December 2018. So let's go to 2018, bottom right there. So the total properties that were in delinquent, not in foreclosure, and number of properties in pre-foreclosure pre-sale inventory had 2.283. All right. Now in December 19, that 2019, that number drops slightly to over 2 million. Obviously, we see November 2020 at 3.5 million, and we see December 2020 at 3.4 million and change. Well, this is where I don't get, because if you had, the 2 million properties as of December 2019, all right, did we just only add 1.2 4 million or 1.3 million and change for this year of, delinquent but not in foreclosure properties? I don't know. So you see, that's the number I'm having. So December 2019, those 2 million properties just didn't disappear over time. And where do those properties go? We've got 3.4 million now. So out of those, we keep hearing that we've got 2.7 million, 2.8 million properties in forbearance. We keep hearing that we've got 1.1 to 1.2 million properties that are delinquent but not in forbearance, any forbearance program, which would give us, almost 4 million. So that's why I'm saying the numbers, I know they're estimates and they don't seem to add up. I really believe that there's a lot of underreporting going on here, and there's more things are more problematic than meets the eye. So I'm going to refer to this slide in the future. All right. Fannie Mae mortgage delinquency rate decreased in December. So mortgage delinquencies for Fannie Mae, which is Fannie Mae, Freddie Mac, they're those the GSEs. They're saying that they actually went down for whatever reason. So that's why things are weird. So we saw it spike up. Now clearly we see that at the gray bar there, the light blue bar is recession, and we see that once recessions are hitting, the delinquencies are spiking. That tends to be typical in a recession. So mortgage forbearances rise for a second week in a row. So here we are. This is January. This came out January 29th, this article, and so it's recent. Forbearance totals are ticking upwards at a time when higher share of such loans are tied to truly distressed borrowers compared with the beginning of the pandemic, when many borrowers took the COVID forbearance as only a precautionary measure. So, and this is interesting because I wasn't too clear on this, and then they've never really talked about it too much, but the forbearance totals, early on, about 50% of people in forbearance were continuing to make their monthly mortgage payments. Black Knight economist and director of market research said in an interview. Now that we've gotten through December, it's down to about 12%. So the vast majority of these homeowners in forbearance are behind on payments, which is, now we know, all right? And that's important. Ultimately, we say, I don't think we should overlook the financial impact of continued deferrals and forbearance agreements on the servicer. That could take a servicer down because of lack of capital overnight, and I would hope legislators are aware of it. Yes, the consumer's at the front of the line for help, but you don't want to create systematic problems for the industry that's trying to support anyone. What they're basically saying is that, this is a bigger problem. This is like the last housing crisis, and hinting, if we're not looking at bailing out some of these servicers, we're going to have a collapse, and that's problematic, and that's what happened last time around. So when you take a look at what's going on in the marketplace, very important. So this is the units in forbearance. 925,000 in forbearance for the GSEs, which are Fannie and Freddie. Government, which is FHA and VA, 1.149 million. Private label, which could be non-banks, it could be Bank of America, conventionals, whatever. You got about 2.764 million. So what we have seen is we've seen this number kind of hover around that 2.7 to 2.8. We've seen on weekly statistics, we've seen things look better, and then we realize, well, why does it look better? Well, it's because people are exiting the program. Well, they're exiting the program. Are they exiting the program because of it's successful, or are they going into different, more distressed buckets out there? So we have to realize that to take this information with a grain of salt, which is what I do. So as I keep saying, there's more out there, and we will see more of this as time goes on. Okay, let me get to the next slide here, guys. All right. Now, slowing mortgage forbearance improvements sets up recovery challenges. So this is really interesting. And again, this is where the numbers still don't pan out here. So the forbearance program gave about 6.7 million distressed homeowners or borrowers an essential lifeline during the pandemic. The president and data of analytics, Black Knight, said in the report, of those distressed borrowers, over 1 million are still in active forbearance from before the pandemic shutdowns, while 4.9 million entered coronavirus-related forbearance starting in March 2020. So I don't know. So we're still 1 million off. So again, that's where the numbers. If he's saying 6.7 million people in forbearance, 1 million are active in forbearance from before the pandemic shutdowns, while 4.9 million entered forbearance, that's not equal. 1 million and 4.9 not equaling 6.7. So among the 4.9 million, 2.3 million removed themselves from forbearance and are performing. Some of them are paid off, some are in active loss mitigation, some are delinquent. However, 1.478 extended their forbearance term, and 254,000 are on the original term. Most plans carry a 12-month limit, and an inflection point for the industry quickly approaches. So what this basically means is that, if you jumped in forbearance, 1.478 million, according to them, extended their forbearance term, and I guess you could say are going to be jumping out of that at some point in time in the near future, which we know end of March, early April, we're going to see some of this manifest itself out. Where this number is going to go, I don't know. Now, this is the estimate. So pandemic forbearances as of December 2020, that's just a larger, of the graph, larger view of the graph. 47% have been removed, expired, performing. 30% are active forbearance, 12% paid off their loans. Active forbearance, original term 5%. Delinquent, active loss mitigation 4%, delinquent 2%. So ultimately what we have here is active forbearance, term extended 30%, active forbearance, original term 5%, active forbearance delinquent and loss mitigation is 4%, delinquent, which is nothing, 2%. So we've got 41% are still in, 39% are still in situated lender, 2% are not in a forbearance program and are in that delinquency status, which means they're going to go through the foreclosure process. But going to these numbers here again, I'm having a hard time, with that 6.7 million and trying to see what 2.8 million. Like as you can see that the numbers just don't seem to really kind of line up here based on what they're telling us. So in the end, my issue is that there's more out there. Now this is interesting, guys. So we take a look at the rate of those exiting forbearance slowed recently, and let's even go first up. The various moratoriums, the first paragraph, which have kept foreclosures at bay over the past 10 months, may be lulling us into a false sense of security about the scope of the post-forbearance problem we will need to confront come the end of March, said this dude. This clearly shows the industry-wide need for post-forbearance waterfalls to determine borrower need and readiness while foreclosure moratoriums are still in place. So yet one more person basically saying, we're having a problem here and the problem's not going to go away and it's just how are we going to deal with it. So I'm basically saying, let's get ready for it. Let's figure out what we need to do to get involved in this. Now, the rate of those exiting forbearance slowed recently, pointing to a higher share of forborn borrowers under distress. At the current pace, without any additional government extensions, over 600,000 seriously delinquent borrowers would roll off forbearance protections on March 31st and leave 2.5 million in active plans. So again, going to this number here, if we're seeing 600,000 roll off because they've expired as of March and leaving 2.5 million in active plans, well, that should equal 3.1 million in forbearance. But we're showing that with the previous graph, that we're in 2.7, 2.8 million in forbearance. So I'm not being picky here, but just another, the point being, you see how the numbers can change. These are from the same people. This is Black Knight saying this. So if Black Knight's saying, hey, we got 2.7 and change, almost 2.8 million in forbearance, but now they're telling me, in the week later article, we've got, this means 3.1 million in forbearance. Am I nitpicking here? Yeah, I'm nitpicking, but the whole point of this is to illustrate that worse than what it really is. So what we see, whatever narrative is or what's going on, everything will be worse. Simple as that, guys. That's my whole point here. And think about this. So after your 12-month forbearance plan, this is what goes on, and this needs to be as crystal clear as possible for the lender, because we heard early on in the pandemic that forbearance is going to solve the world's problems. We're going to be great. Housing's fine, not a problem. So what has to happen for this to work? Well, the homeowner, the borrower, has to basically, for forbearance to work, it means you've done your 12 months forbearance. For the lender to put that 12 months worth of missed mortgage payments at the back of the loan, which they promised they would, and they can do that. That's great. I still think there's some criteria that goes along with that. Well, that means you have to now continue your mortgage payments. You got to restart them again. Well, if people are deferring, that means they don't have the money and they keep deferring their forbearance. They've gone from their first plan to their subsequent plans, whatever, means they don't have the money to pay their mortgage. So if they don't have the money to pay their mortgage, they fall into loss mitigation. Loss mitigation is a suite of solutions. The suite of solutions are loan modification. Loan modification means you got to pay something on your mortgage and restructure your mortgage. So a lot of people won't be able to do that with their lender. Loss mitigation means deed in lieu, giving your property back, I guess voluntarily. It's a soft foreclosure to the lender. Who's going to be doing that? Loss mitigation means short sale. If you're underwater and you got to do a short sale, that's a solution. That's a much more elegant, better solution than a foreclosure. All right, foreclosures where the buckets where a lot of people are going to go. Now, the housing hype hacks, as I like to call them, because they refer to guys like me as housing bubble bros. Everyone in that segment of journalism or whatever, and I say that with complete disdain and scorn, of course. What they're saying is that, hey, anybody who falls into these categories, they're not going to have a problem. Why? Because all this equity they've built up, they'll just sell it and off they go. Well, you know what? It's not going to be as easy in many locations across the country. Just simply sell your home and walk away with equity in your pocket. Okay, not going to happen. It's not going to happen. Some will sell. They'll be able to. They're not going to walk away with all this huge equity. They're going to have to take discounts. Thus, the buying opportunity for either people like us or investors, etc. But there's going to be a lot of carnage that goes along with this. And as I always say, because these numbers are not clear and don't always add up, or we see them fluctuate from article to article, things will be worse than what appears today. That's my narrative, and that's how we're going to move forward. All right, guys. So where foreclosure auctions are returning, fourth quarter 2020. It's put out by auction.com. Right? You can see that obviously the blue states are not seeing very many foreclosure auctions picking up. Why? Typically because of the structure or the foreclosure law structure of that state, number one, and two, because of some of these states may have stricter moratoriums and not much is really happening. Where you're seeing foreclosure auctions, vacant homes, abandoned homes, they're going to go for foreclosure auction because there's no reason to hold those back. And now the green states are seeing more activity, and you're going to start seeing that as the year goes on. Obviously, the darker the green means it's a percentage. So the deeper the percentage, the greater the percentage of foreclosure auction activity happening. These are auctions being filed. So obviously, we can see how that plays out across the board here. But when you take a look at it, the blue, some of the blues are getting bigger and the greens are getting greener. And this is what's going to happen because the market just can't. The market needs these properties to give us more choice, to give us more inventory, to have, I guess you could say, some cheaper property entering back into the market, to help push prices down. Listen, it's competitive as heck out there right now, but there is opportunity here. You may want to investigate this. All right, that's all I'm going to say to this. This came from John Burns, and he just put out the biggest real estate surprises by 2020. And this ties into what I'm saying about how our market's manipulated and where things are going. Some of their biggest surprises of 2020 here: rapid innovation saved the housing industry. So what could we do? Well, we were able to do virtual tours and have all the COVID protocols and stuff. So that allowed people to become more internet savvy. A lot of real estate agents and companies did more pictures, more photos, more drone, more whatever to make it easier for people to purchase, do a lot of their work and looking online. Obviously, federal stimulus came in, but quite frankly, the federal stimulus that's being offered right now, that's not, that's a one-timer. That's not a monthly stimulus. It's not going to solve rental, issues and back rent, and not going to help landlords. But we also saw is repair and remodel. So the Lowe's and the Home Depots basically did what? They did well because people either reconfigured their homes they live in now for the pandemic, to do work at home, and people who are out buying some places maybe are spending money to equip them a little differently with the needs of what's going on here. This is interesting. Single family operators are competing for land, and why this is important is that I talk about the hedge funds, institutional investors. They're buying at foreclosure. They don't buy at peak prices. They're not retail buyers. They're discount buyers, all right? So they're not going to buy your home because you want market price for them and make repairs and rent it out. That doesn't make sense. Doesn't make sense from a cash flow or appreciation perspective. They're going to buy where they can buy at discounts. They're going to buy from the lenders in bulk purchases. They're going to buy at the auction because they can push prices down, and they've got the capacity to do so with all their money. But what they're doing now, and this is something to take notice of, is that they're doing what's called they're doing build to rent. This is a big thing now. So as I mention all the time, the single family rental has become an asset class, and operators are competing for land. So you've got these big institutional investors who are now going to the home builders saying, you know what we're going to do? We're going to work with you. We're going to buy the land and you're going to develop it for us. You're going to build homes and we're going to build to rent. And that's what's going on a large scale now. A lot of it's happening more in the Southeast here. At the bottom it says, in the fourth quarter, according to our land survey, build for rent accounted for 3% of all finished lot transactions in the fourth quarter of 2020, including an amazing 8% in the Southeast. So you're seeing build for rent on individual lots. You're seeing new things happening out there. I personally like the build to rent opportunity. I'm trying to create that opportunity now. I think to tag along this, we're going to see other things like container homes and alternative style of homes that are there to reduce price or whatever. So we're going to see a lot more of this. But this is what these big investors are doing this now, and they're just creating rental investment communities right now, because for them, they can go to the builder, they can knock out these houses, they can get aggressive pricing. And if you're buying a brand new house, as I mentioned earlier, what are you getting in a brand new house? 30-year roof life, 10 years minimum on your air conditioning, builder warranty. So the deferred maintenance for a hedge fund is going to be virtually nothing in this case. And so that's great. So it's just, and they can probably rent the stuff up for a premium as well too. So this is where things are going. You guys need to get involved in this and contact me and I can show you how to do this, because I'm looking at this heavily right now in my area. All right, guys. As I say, opportunities knocking. So we have to take a look at this. This is, auction.com. I'm going to keep showing these slides. So this is their conservative statistics of what's going to happen in the next little while. So I think we're going to see more than these foreclosures. It was further adjusted to 3 million foreclosures. Add that 1.1 to 1.2 million delinquencies not in a foreclosure forbearance plan. We're going to see 3 million, 4 million foreclosures minimum as time goes on. Going back to this chart, we already see where things are at, 3.4 million now. And we're seeing that the numbers aren't adding up, and we're taking a look at who's in forbearance and delinquent. So that's why I'm saying this is a conservative or underreported number. I think these are just based on estimates and samples that they're taking. So it's tough. I'm not knocking these guys. I'm just saying it's tough to get the numbers. I struggle with this, but listen, I've been looking at these stats for 10 plus years in this segment right now, and I can tell you that it's underreported, and there'll be more there. And the narrative and the housing hype hack guys, they all talk about equity and we'll solve this housing affordability crisis. Things will be great. We're not going to have any problems. Well, you know what? That's their position. My position's different. It's an underreporting and an underrealization of what's going to happen. But the whole premise of the video was, could this Robinhood GameStop thing be happening to real estate? It is happening, and the reason being because it's giving us a narrative to go over here and not worry about things. The market will take care of itself, but the real people who will take care of it is the big investors coming to swoop up and eat our lunch and get all these properties before we can blink an eye, and you're just going to have to rent the rest of your life. Okay, that's where we're headed for this, and it's not the American dream. That's not why I'm here. And it's not why many people are here, and that's the way it goes. So, having said that, what are people saying that are in the data world? Short sales and pre-foreclosures are poised to become the more dominant share of the stressed market going forward this year and going forward. There you go, guys. In hot markets, what do? Find distressed property, fix and flip it, sell to retail buyers, do cash flow rentals. People are flocking these hot locations. We've talked about the Austins, the Nashvilles, the North Carolinas, the Tampas, locations across the country. So in cooler markets, which cooler markets are just not as hot as the hot markets, find distressed property, fix and flip it, sell to retail buyers, get cash flow rental. Why? Because there's still buyers there. There's buyers everywhere. Buyers aren't the issue. It's actually getting your hands on the product is the issue. And people will flock back to these locations. There'll be price adjustments, so it might work for you depending on the market you're in. So with distressed property, why? You are acquiring for less than retail relative to the timing of when you actually buy it. So again, as I always say, you don't wait for material discounts, because if you don't buy a property today because you think in 6 months it's going to be cheaper, well, guess what's going to happen? You're not going to get that property in 6 months because somebody bought it tomorrow. You see, that's the whole point here. So people who want to wait for their dream property are going to be sadly mistaken when things actually shift and they find themselves looking, outside in. So please don't make that mistake. 1% of all the on-market sales fall into distressed property categories. REO and short sales. No one's doing short sales. How do we know this? Because back to the 1% rule, if people were doing short sales, that would be more than 1%. So because no one's doing short sales, it's less than 1%, and thus the distressed property, shadow inventory options and opportunities are sitting there waiting for us to go get it, guys. Anyway, foreclosure filings are quietly increasing. More properties are scheduled for foreclosure auction. Go back to the 1% rule. Go back to what I started talking about, being the market being controlled, manipulated, and how to work around that. That's our game plan for going forward. So please reach out to me. You know how to get a hold of me. Do an email. All right. Give me a shout, whatever you want to do. Just connect with you. There's my email. So once again, thanks for the views, likes, comments. Please share the video with your family and friends. Don't wait for things to change, or people say kick the can down the road. Understand it and learn it now, because it will service you much better in the near future. All right, guys, take care. We'll look forward to talking to you in a little while.